Hello, neighbors, and good morning to you, my friends. We are back today in finance, learning the wonderful world of finance in the neighborhood. I am Squealer D, and I am back again. I know you guys just heard some feedback, but I had to make sure that I was loud enough. I have trouble with my sound. I don't know why, but sometimes I don't want to turn it on, and I don't want to turn it up high enough. I don't know, guys. And also, I have been guilty of recording with no sound. So if you ever see me and I'm here talking, and you hear nothing, say, "Hey, Squealer, you're not recording. Hey, you have no sound." And I'll fix it. I know how to fix it, guys. I'm just not very good at remembering to fix it. Okay. So, guys, yesterday we're here talking. We had a great day, and we talked about looking at the different investment strategies and trading strategies. So I figured today we'll look at the 4 key investment strategies before we go into trading. I said next week, Monday, have your Webull ready, guys. Webull or Think or Swim. And I showed you Think or Swim yesterday. Think or Swim is with TD Ameritrade. And personally, guys, I've got to tell you a little secret what happened today. It's not a secret. It's just what happened. It's updated news. So I opened up my TD Ameritrade about a month ago. And I used it for about 2 weeks where I was trying to learn it. And that's when it was so overwhelming, guys. It was a lot to learn. And I decided that we should all learn it together because it was just too much just for one person. Like, I had to make it worth it, and making it worth it for me was sharing this knowledge. I don't think anybody should hoard knowledge. So if I am going to learn, my friends, I want you to also be able to learn. You don't have to learn, but I would like you to be able to learn if you decide to. So here I am, learning online. I had to open up my chat bar, guys, just in case somebody bops in and says hi. I want to be able to say hi back. But I opened up my TD Ameritrade a month ago. I've been using it, just paper trading, guys. No money is deposited. It's just a paper trader account. And I can trade $200,000 of fake stock and just practice. So I also thought that I would open up a Webull so we could give that a go also. And we could try to figure out which one is better for us so that when we're using real money, we don't make a mistake. We are trying to eliminate all mistakes, guys. But I went and signed up for Webull this morning, and it's pretty easy, guys. You put your phone number in, and then they ask you for your ID, and you have to show a picture of your ID. I just did it all through my phone. It was super simple. It took me 3 minutes while I was setting up the stream today. But, guys, they ask you all these questions, like, what is your experience? How much trading experience do you have? And I was honest. I said that I have no trading experience and my knowledge is limited and that I have limited funds. I was very honest. And then they sent me an email just now and said, "You are not approved for options trading because it's too risky for you." So they slapped Squealer D down, guys. They told me I couldn't play on Webull with option trading because I am not educated enough. So here we are, getting more educated so I can go and re-answer those questions, tell them that I'm the GOAT, and then I can trade, right? And if not, we'll just use TD Ameritrade. No big deal. But just so you guys know about Webull, either you tell the truth like I did and you get blackballed, or you lie, or you learn and then open up the Webull. I don't know. I already opened up mine. They emailed me, told me that I could not option trade. That's fine. It is perfectly fine. We're not in a position to learn options anyway. We can still bop into TD Ameritrade and Webull and just look at the difference. The difference in how their setups are and see which one we like better like that. And that's okay. Whatever. I mean, you can keep us out, but you can't keep us out forever. We'll be back. So, guys, this is Yahoo Finance. I thought it might be helpful for us this morning to just bop on here and see what the news is before we get going. Because we remember that one of the investment strategies is following the news. So we got to stay up on the news, guys. So just jump through Yahoo Finance and see real quick if we see anything that makes us say, what? So Tesla cuts prices in U.S. for 5th time since January, guys. That will affect Tesla's stock prices. Let's see what Tesla is and how it's going up. It has cut 5 times. That is crazy. Tesla is at 185. It's down 0.25% today. Let's see their weekly. So we bop into here, guys, and this shows us, this is their ticker, Tesla, TSLA. That's called a ticker, the TSLA part, or their symbol or ticker. I don't know, guys. Is a stock symbol called a ticker? What's a ticker? Oh, yeah. A stock symbol or ticker is a unique series of letters assigned to a security for trading purposes. A ticker. Okay, guys, I was right. Look at me learning the words. I'm like a real stock person, guys. Okay. And I have to say stock person because I'm not at the level of a trader yet. So here's their one day. It's just today's, guys, since open. This is the open at 9:30. And it opened low. It went kind of high. Let's look at their 1 month because it says since the beginning of the year. Let's check their 6 month. So it's went down a couple times. Probably every time that he lowers the price, it goes down. 1, 2, 3, 4, 5. Maybe that was the 3rd time. That was the 4th time. That was the 5th time. Wow. So it makes sense, maybe, because he's at 185, maybe like they're trying to keep the stock down a little bit. I don't know. The long term, it's up. Because if you look at the 5-year, look how much higher Tesla is in the 5-year. Man, Tesla went all the way up to 381. Wow. So that was Tesla, guys. Let's see if we see any other interesting information that might help us today. Yields climb. S&P futures close higher after jobs report. So jobs reports are good things to look at, guys. Hiring slows but remains strong. I don't believe that the hiring. I don't believe these reports. I think that they make up jobs because they took out PPP loans or PP loans, whatever those protection loans were, personal protection loans during COVID. I think a lot of the jobs took those out. And in order to not pay back your PP loan or your PPP loan, whatever the heck that loan was called, your COVID loan, in order to not pay back your COVID loan, you had to hire people. You had to be hiring. You had to be paying your employees. So it makes perfect sense if now, post-COVID, they all want to keep their loans, right? They don't want to have to pay these craps back. So what they do is they pretend like they're hiring, but they're not really hiring. And then they don't have to pay back their PPP loan. Bam, bam, bam. Tricky little dickies. But they are, guys. So crypto may finally be through the bear market. So guys, remember bear downs on you. So that means it goes down. So cryptocurrencies continue rebound. As some say, crypto is through the bear market. Cryptocurrency surge in the first quarter, a surprise turn for a market that weathered a meltdown in 2022. Yeah. Dogecoin down. Ethereum down. Bitcoin down. Well, it doesn't look like it's up. I guess it is, guys. They took a big old dip, huh? So of everything I do own, guys, I do own a couple stocks. And I have a couple cryptocurrencies. During 2020, while we were bored, I decided that cryptocurrency was something that I wanted to watch. Even though I didn't understand anything about the stock market, I wanted to watch crypto. I don't know, I was interested in it. So what I did was I opened up a Robinhood account and I bought a couple stocks and a couple crypto just so I would be forced to watch the market. And it was actually pretty fun, guys. I own 53 Dogecoin. I think it's worth like $3.54. And then I own 7 shares of, I don't remember what, Westport Fuel or something. I think I own an energy stock. And then I own the Dogecoin. That's it, guys. Just a couple little stocks. I'm worth like $11 in the trading community. But sometimes my $11 is worth $15. That's almost like, I don't know, an ice cream bar. Anyways, so Dogecoin, guys, going up. Bitcoin going up. And like we said, these coins are probably going to, because so many people have invested so much money into it, it's going to be rocky. But overall, like I said in a couple lives ago, I told you that if you would have invested in cryptocurrency when Biden came to office, if you would have invested $100 into each one of these, you would have $700 by now. So these are paying long term. They're paying. It's just long term. People think that they can get in right here and sell right here and make $1 million on crypto, on anything. And that's just not how it works. So you can see over 5 years, it started big. It's still kind of, they're kind of little. But in a year, you can see it went up, it went down. These are great, guys. I'm a geek when it comes to maps and symbols and charts, and this is kind of interesting. So let's see what we got going on over here. Make sure that we are ready to go, and we are going to learn. Oh, let's see if there's anything big or interesting. Oh. Hyundai's new EV plant will leave 2 huge footprints in the United States. These kind of things, guys, with Hyundai opening up new EV, investing in EV may be the way to go or not the way to go. So reading these news articles to see what you want to invest in is the best way to go. So IRS gets $80 billion. Bidenomics. Airbnb stock falls. Man, Airbnb, guys, is going downhill. It's going downhill not from this is what I'm reading, and not from looking at these. It says it's down 4.9%. Let's look at its chart. So on the 1 month, 1 month it's down, guys. It was up 124. At the beginning of the month, it was at 128. It's at 109. Let me see their 6 month. So it's all relative, guys, because 1 month is down, but 6 months is still pretty relative. Let's see, a year. They were at 170 in 2022. At 5 years, they're down from 5 years. Yeah. Airbnb's having a rough time because people don't like all the fees that they charge. Yeah, and guys, Airbnb, I keep hearing about cameras everywhere in Airbnbs. Cameras in the walls, cameras in the bathrooms. Be careful when you go to an Airbnb. Look around for cameras. I keep hearing that. Keep hearing it on internets. I keep hearing it from people I know. And they're not always egregious cameras, guys. Sometimes they just want to watch and make sure that nobody's having a party at their house. Sometimes these cameras aren't in the bathroom. But what happens if you want to use the house for things that aren't normal? Like, for instance, it doesn't even have to be weird or gross, guys. For instance, you rent an Airbnb and you have a couple people staying in the Airbnb. Your brother's in the bedroom, your mom is in the other bedroom, so you're living in the living room, which is totally fine. You guys are on vacation, you're sharing a house, you're saving money. That's beautiful. It's beautiful. But it also means that you may, while your brother's in the shower and your mother's getting dressed, it may mean that you get dressed in the living room, right? Now, what happens if that Airbnb has a camera on the fireplace of that living room to make sure that there's no parties at the house, and they're watching it, but you're changing. Totally inappropriate, total invasion of privacy, illegal as heck. But they didn't mean to watch you change. They just wanted to watch their house. People like that, they don't have good risk management. They are willing to take your privacy in order to cover their risk. So it seems to me like you can't trust Airbnbs because they're more concerned about their risk than your actual safety and comfort. So Airbnb is, and that's not to say, guys, I just said all of that stuff, but that is not to say that I would not purchase this stock on a low and sell on a high. That is not to say I said Airbnb has a lot of problems. That's what I've heard. But that does not mean, guys, and get this, put it in your little memory bank or write it in your book. Just because we don't want to stay at an Airbnb because they might be doing dirty things does not mean that we won't purchase Airbnb stock. It does not mean that we won't sell Airbnb stock or trade options of Airbnb. It just means that we know not to stay in an Airbnb if we don't want to be violated. We have to take emotions of things we do with ourselves. We protect ourselves. We have to take that out of our thoughts when we invest. We do not want to invest in a company because we like the people who work at the company. We don't want to invest in the company just because we like the name of the company. We don't. We want to do good risk management, and that means having strategies, entrance, exit, and reasons why we are picking the stock, not just because it looked pretty or because I went and stayed in an Airbnb once. That's not going to happen, guys. You have to take your emotion out of trading. No emotion in trading. We can't be crying over spilt milk or Airbnb having cameras when we're trying to get rich. I promise you, those people that are trading millions of dollars in the stock market every day, they do not care about hidden cameras in Airbnb if they're trading Airbnb. And that's where we have to get. And that's it. So we've looked at the news for today. This is pretty much how our morning is going to start on days that we trade. We're going to come in here. We're going to check out. We will make a watch list, guys, of, I don't know yet, but I don't have a watch list. Recently viewed. No recently viewed. Most active penny stocks. Penny stocks are not good for people like us that can't handle risk, guys. But they sure are fun. Look at all this volatility, guys. A 23% change in Skills Inc. That's crazy. Finance of America companies, 30.41%. Let's see their 1 month ticker. Ooh, look at them going up. 6 month ticker. 1 year ticker. 5 year ticker. You see the difference? Like 5 year, it looked like they were up 11.14 in April of 2021, guys. And since then, it's been a steady decline. In the last year, the decline's just been, a little ups and downs between $1 and at most $2.50, $2.60. So in the last year, it's only went up, 50 cents. But in 5 years, it's went down, man, $10. Woo! Okay. Penny stocks, guys, they are volatile. And remember, volatility is what makes money. But you have to be careful because it's high risk. Risk management, guys. Risk management. So let's get started on this. We'll breeze through 4 strategies. We're going to learn 4 key investment strategies so that when we go into trading, we have our strategies set. We know what we're going to do. So choose a strategy that fits your profit objectives and skills. An investment strategy is a set of principles that guide investment decisions. So this investment strategy, that is our investment rules, guys. Investment God. Our strategy is what guides us. That is your investment guru. Good coffee today, guys. No salt around the rim. I licked it to make sure because I don't know how that happened last time, but I was not about to have a bad cup of coffee. So, there are several different investing plans you can follow depending on your risk tolerance, investing style, long-term financial goals, and access to capital. Investing strategies are flexible. If you choose one and it doesn't suit your risk tolerance or schedule, you can certainly make changes. However, changing investment strategies come at a cost. Each time you buy or sell securities, especially in the short term in non-sheltered accounts, may create taxable events. So, every time you buy or sell something, you might have to put that on your taxes for the year. Every time, guys. Every time you sell something, it might be taxable. So, you may also realize your portfolio is riskier than you'd prefer after your investments have dropped in value. So you buy something, you think you have risk management, drops in value, and now your portfolio is worth less. Here we look at 4 common investing strategies that suit most investors. By taking the time to understand the characteristics of each, you will be in a better position to choose one that's right for you over the long term without the need to incur the expense of changing course. So, key takeaways. Before you figure out your strategy, take some notes about your financial situation and your goals. Value investing requires investors to remain in it for the long term and to apply effort and research to their stock selection. Investors who follow growth strategies would be watchful of executive teams and news about the economy. Momentum investors buy stocks experiencing an uptrend and may choose to short sell those securities. Dollar cost averaging is the practice of making regular investments in the market over time. So 4 different strategies, guys. We need to pick one for the short term. And like they said, you can change in the long term. We don't have a long-term goal right now because we don't have a long-term bank account. We have a small bank account that we're going to grow in. Oh, no. I don't know if we had a disconnection on my OBS or not, but we will see. Okay, hopefully not, guys. We're going to keep going. So, before you begin to research your investment strategy, it's important to gather some basic information about your financial situation. Ask yourself these key questions. What is your current financial situation? What is the cost of living, including monthly expenses and debts? How much can you afford to invest, both initially and on an ongoing basis? Okay. So, I believe my financial current situation is I am trying, guys, to go from the bottom up to the top. I have my cost of living and expenses and debts taken care of, and I am getting my emergency. Remember, I told you guys, before you start this, I want you to have an emergency fund. Even 3 months, guys. I keep saying $10,000, but even if you can get 3 months worth of rent, 3 months worth of your car payment, 3 months worth of food for you and you and who you take care of. If you can do that and have something to fall back on, the world will be a better place for you. I promise you that. I promise you that your life will be better if you have some money for an emergency. Not for your next bill, not for your next meal, but put away so that if you have an emergency, it is there, but you don't use it for anything else. And then start to build a savings account for this, guys. I am working right now to save $1,000 to put into my trading account. It's what I'm thinking, $1,000 to start. And I am going to look at it as learning money, guys, not investment money. If I look at that first $1,000 as learning money, in my brain, I won't be so sad if we have to use $1,000 to learn. If it costs us $1,000, we lose it all. That's kind of a good investment. I'm not saying it's a great investment because, we lose $1,000, but you lose more than that when you go to school. If we went to investment school, we would lose more than that. Now, am I counting on losing the $1,000? No. Do I want to lose the $1,000? No. But we have to make ourselves okay with losing money. It's part of risk management. So, How much can you afford to invest, both initially and an ongoing basis? I do have a plan to continue to put money into my investing account on an ongoing basis, because guys, money grows exponentially. I keep saying that every time we're here, but I'm going to keep saying it. If you save $100 and you put that $100 in and you make 7% off that, that's $7, guys. You have $107. If you make 7% off of $107, guess what, guys? It's more than 7%. I wish I knew percents off the top of my head, but alas, I do not. So let me see. What is 107 times 7%, guys? Oops. Let me see. 107 times 0.07 is $7.49. You see that? You got 50 cents more because of your last one. So now you add that to the 107. Now you have 114.49. What does that go? 114.49 times 0.7%. That gives you another $8. You guys see that? Now we have 114.49 plus $8. You guys, by the third 7%, if you get 7% each trade, by your third trade, look, you're at $122. You're making money. $122, guys. You started with $100, and after three cycles of putting the money in and getting it back out with a 7% gain, and that's saying you don't lose it, guys. Let's say you win 3 times in a row, 7% gain. You'll have $122. You made $22 in 3 trades. See how easy that was? And that was only with a 7% gain, guys. 7%. So, keep growing your money. If you have to add $100 a month, say you add $50 a month to your plan. Let's say all you can afford is $20 a month after you get your initial $1,000. $20 a month, okay, guys. You're going to be growing it. It's okay. Everybody thinks that they have to be rich to get rich. And you do not have to be rich to get rich. You just have to think rich. And rich people, they take that $22 and turn it into $2,200. And they take that $2,200 and they turn it into $22 million. And how they do it isn't that they work for the money. They throw their money into situations that works for them. So, even though you don't need a lot of money to get started, you shouldn't start investing until you can afford to do so. If you have debts or other obligations, consider the impact investing will have on your short-term cash flow before you start putting money into your portfolio. So, what I've been doing for a month, guys, is you see I'm not trading. I'm learning and I'm saving. I'm learning and I'm saving. And it's okay if you don't start at the same time I do. Perhaps you'll watch me trade for 2 months while you save up. And that's okay, guys. You will learn more. You'll be better off than me. You'll start at a position where you're smarter than me and you can trade easier. It's okay to wait, guys. I've waited 40 years. Here I am, 40 years old. It's okay to wait. Make sure you can afford to invest before you actually start putting money away. Prioritize your current obligations before setting money aside for the future. Pay yourself first, guys. I'm going to say it every time we talk about money. Pay yourself first. Those bills are still going to be bills 7 years down the road. They will wipe them off your credit. Pay yourself first. Unless you are going to go to jail, pay yourself. Put money in a savings account for you before you pay other people. They're going to do it. Do you think that the PG&E, public gas and electric, or whoever you have in your neighborhood is going to go bankrupt to provide you a service? They are not. They are never going to go bankrupt to provide you a service. They will shut your service off. They will shut you down. They will lie to you. They will rip you off to do anything it takes to ensure that they are paid first. So if they will do that to you and leave you in the cold, why can't you pay yourself first? You can, and you should. This whole idea of people paying their bills and living in abject poverty is crazy to me. It's absurd. We have all these houses and people live on the streets. It's absurd. We as Americans need to step up and stop letting people take advantage of us. Stop letting people make us treat ourselves like dogs. We are not dogs. You are not a dog, and you should not consider yourself a dog. So therefore, pay yourself first and care about yourself. That's my greatest advice to you. Even if you never trade a stock in your life, put yourself first. You will win. You will be rich in life. You might not be rich in money, but you will be rich in life if you put yourself first. I promise you. And I'm not meaning be selfish. I'm not saying to steal from people and take people's stuff. I'm saying you put yourself first in the manner that you are taking care of yourself. So if you're being a good person and you're doing the right things, you don't have to worry about hurting other people because they will be hurting themselves. You do what you need to do for you, and you do it in a good spirit, and nothing bad can come of it. And if it does, it won't come to you. It's okay, guys. People need to stop with this narrative that everything is okay. I say everything's okay, but I mean it in a way that we are going to learn so we can make everything okay, guys. But just naturally, everything's not okay. You have to make it okay for yourself. Some people think if you just do certain things and you act a certain way, that things are going to be good. But I believe you have to make it good for yourself. You have to pay yourself. You have to protect yourself. And you have to teach yourself. Things don't come to us like that. Sometimes they do. Sometimes you're rich and you're lucky and you're beautiful and things just come to you. But that is not for everybody. So set out your goals. Everyone has different needs. So you determine what yours are. Are you saving for retirement? Are you looking in to make big purchases like a home or a car in the future? Are you saving for your children's education? Will this help you narrow down a strategy as different investment approaches have different levels of liquidity, opportunity, and risk? Guys, I'm going to say one thing about your child's education. Are you saving for your child's education? Are you teaching your child about money? I think that that's a better question than are you saving for your child's education? Are you teaching your child about finances? Best question. Forget their education, guys. Forget paying for your child's education in the future. That might not even be available to you. The way that things are changing, your child, your 5-year-old child, they might not go to college. You might not be able to afford it. Colleges might be so expensive by the time you get there that only the uber rich go to college. So are you going to save $1 billion for your kid to go to college? Probably not. What would be a better plan? Teaching your child about finances so that they can pay for their own education. If you teach your child everything that we're learning now, by the time that they're 17, 18, and they can trade their own, be on the stock market. This stock market's been around since 1792, guys. 1792. And we are not teaching our children this. Why? Why are we paying for their education, worrying about their future education, but not teaching them simple money matters? Why is this not in schools? Why do we not teach money goals from the time they're born? I tell you, if you are reading this and you're worried about your child's education in the future, you should be worried about it right now. You should invest the money that you're saving so that you can learn about money, so that they can learn about money, and you can both be better off. That's my advice for you. Now I bop off my soapbox and continue to read. Next, figure out what your risk tolerance is. Your risk tolerance is determined by two things. First, this is normally determined by several key factors, including your age, income, and how long you have until you retire. Investors who are younger have time on their side to recuperate losses, so it's often recommended that younger investors hold more risk than those who are older. Risk tolerance is also a highly psychological aspect to investing, largely determined by your emotions. Guys, and we said we're not going to be emotional. How would you feel if your investments drop 30% overnight? Well, guess what, guys? If you have something invested and it drops 30% overnight, you didn't have it invested right now. We're not invested right now. So you still have 70% more than you had right now. So if your portfolio is worth $1,000 less tomorrow than it was the day before, guess what, guys? Your portfolio is worth nothing right now. Wouldn't you rather say that you have a portfolio that gains and loses money than say you have no portfolio at all? People scare themselves into thinking they can't do something because they can't handle a risk. But what about the risk you're taking right now by not doing it? Guys, the risk of you not partaking in the stock market is a big risk. You're risking a future of monetary stability. You could be so stable monetarily that other issues won't affect you as much. But if you don't partake, you've risked more than $1,000 or 30% overnight. Sometimes the best strategy for making money makes people emotionally uncomfortable. And so that is why we are taking so much time on this and talking about it so much, guys. By the time we get in there and trade real money, we are not going to be emotionally uncomfortable. We are going to be okay with the fact that money comes and money goes, money stops and money grows, and that's okay. If you're constantly worrying about the state of possibly losing money, chances are your portfolio has too much risk, or you have not, in your mind, created a good risk management that you trust. If you can't trust yourself in risk management, how can you trust life? How are you going to get through life with no investments? You invest in people. Why not invest your money? People invest in people all the time. They invest their whole lives in their husband and get divorced. I mean, how much did you have to learn about your husband? What they like, what they don't like, what size they wear. I mean, you learn everything about your husband. Learn everything about the stock market, guys. You don't. Let's say that this portfolio right here, 30% overnight and $1,000 lost. It's risky, guys, right? Sounds scary. Like, I don't have enough money to lose $1,000. But let's think about this way. Let's say instead of your portfolio, this $1,000 lost last night was your husband. You got a husband that you've been with him for years now. And he went out last night with his buddies and he lost $1,000, guys. You don't know how he lost $1,000. He just lost it. Did he spend it? Did he get a hotel with a girl? You don't know. You do not know. You just know that he went out with $1,000 of cash in his pocket, and when you saw his pockets in the morning, they were gone. So, did your investment drop 30% overnight? Your husband lost your money. You can't trust him. Did he get a prostitute? Was he in a hotel? What did he do with that $1,000? Did he just buy his buddies drinks all night because he wanted to look like big spender? You don't know. It's an investment, guys. We invest all the time. You invest your trust in your husband that $1,000 wasn't really lost on purpose. So, therefore, if you can trust your husband with $1,000 to go out overnight with his friends and his stock didn't drop, you don't love your husband less. Maybe you're mad, you're peed off at him because he lost $1,000 and it's a lot of money, but you're not going to get divorced over $1,000 unless he was really probably with the prostitute. You take some type of risk management risk when you get married. And you know that they can mess up your money. They can mess up your life. They can mess up your day. But you still take that risk because it's worth it to you. So what I ask you is when you think of your portfolio and your money and you think of this, of what we're doing here, of investing, you think of it like you think of your husband. You think of it like you think of your diet. It has a lot of risk, guys, but it's worth it. You might not feel like it in the moment, but what do you feel like right now having no investments? What do you feel like right now having no portfolio and no future? It's pretty risky, right? Who's going to take care of you? You guys know that we are 80 million healthcare workers short, right? I don't want to be a healthcare worker. This is not about asking you to be a healthcare worker. I'm just letting you know. We are 80 million healthcare workers short. So that means, guys, that when we get old, I'm 40. When I'm 80, how many million healthcare workers are we going to be short? How many? If I'm 40 and we're 80 million short, are we going to be 160 million short? Are we going to have no healthcare workers when I'm 80? When I'm 80, I'm going to need care, guys. I've already needed care. I've had 2 major back surgeries. I've been in the hospital for 2 weeks at a time. You know how many healthcare workers took care of me? Do you know how many healthcare workers you need when you have a major back surgery? So what are we going to do, guys? What is our risk if we are 80 years old and we have no portfolio, we have no money, and there are no healthcare workers? What are we going to do? Are we just going to lay on the side of the road and die? Are we going to lay in some kind of state public hospital thing? They're going to call it a hospice, and we're all just going to lay in there and die with no healthcare workers? It's what it's looking like, guys. And do you think that the people with big portfolios, the rich people, the top 1%, the 22 millionaire or the 22 million millionaires in our country, do you think that they're going to be worried about having no healthcare workers? No, they're going to buy their healthcare workers right now, guys. They are buying their healthcare workers right now. They are investing in their future health right now. So if we don't get a jump on it, if we can't control our emotions enough to think about $1,000 loss, just like if your husband lost $1,000, then we are not going to make it in this world in the future, guys. We are going to be those old people bums at the bus stop with our booties out in a nursing gown, because I've already seen it, guys. I have seen them take old people and drop them off at the bus station from the hospital. You get discharged from the hospital in a hospital gown. I do not want that to be me. So, and I am here, guys, because I do not want that to be you. That is heartbreaking, seeing a little old person at the bus stop in a nightgown with his booty out and a walker, because there's no care for them. There is no homes for them. There are no spots for homeless old people. So if you lose your shirt and you turn 80 and you have nowhere to go and there are no healthcare workers and you have nothing, that is a bigger risk than risking on the stock market, guys. And that brings me to my other thing. Are you alone? It's hard to do things alone, guys. You need a team. And I know that this is going to come over like, oh, just get what you don't have. No, guys. Just like you need to be emotionally comfortable, you need to be supported. You need to have a team. And even if your team is just coming here, guys, and getting a little bit of information and a little bit of encouragement, it's better than nothing. Get a team, guys. Get yourself a team together. The best thing I ever did after my back surgeries was find my team. And you may need to make a list, guys. I did. I actually laid down in bed and I told myself, I need things. What do I need? And I wrote it down. I needed help. I needed help losing weight. Guys, I was fat. I was almost 300 pounds. I had gained 100 pounds after my back surgery. And I was fat and I was miserable and I needed help. So I wrote down, I need help. And underneath it, I put, what do I need help with? I needed help with money. I needed help with my children. I needed help with walking. I needed help with cooking. I needed help just with my mentality, getting away from pain. You guys, pain is mental. And I know everybody says that, oh, well, it's not mental when I feel it. It is mental. Your brain sends a nerve response with chemicals and hormones down your nervous system to feel pain. It is an actual communication between brain and feeling, your nerve endings. My nerve endings are on fire all the time. And you know what my brain tells them to do? To shut the heck up. And you can train it to that. You can train your brain to tell your nerve endings to shut up. People do it all the time. They get their leg cut off and they can still feel their foot. And eventually they learn to tell those nerve endings to shut up, or they don't, and they feel their foot for the rest of their lives. They feel their foot have cramps. They feel their foot have burning sensation, and the foot's no longer there, guys. You can emotionally and mentally control your pain. You just have to learn to do it. So therefore, get yourself a team, guys. A team. A good team. It can start out as a crappy team, guys. Any team is better than no team. I started out with a team, and it has changed since. I have added new people, and I took other people out, and that is okay. That's what a team is. How many times do they trade people in professional basketball or football or whatever? They trade people, right? You can trade people out of your team. It's okay. It's okay. It's okay to trade your own family. They could be blood relatives. If they're not working for the team, if they're not helping your mentality, if they're not helping your money, if they're not helping you, get them out of here. Like Donald Trump said, get them out of here. Every time, guys. If they're not helping you, get them out of there. That way, you can get to an emotional state where we can control money like we can control everything else, guys. But first, we have to learn that control. So here we are, sitting here learning control. Risk isn't necessarily bad in investing. Told you guys, volatility is risk. Higher volatility is higher reward. Higher risk investments are often rewarded with higher returns. Every time I'm going to keep saying it, guys. While lower risk investments are more likely to preserve their value, they also don't have upside potential. So we can, guys, ladies and gentlemen, neighbors and friends, we can take all these low risk investments our whole lives once we get rich. We can get old, we can get rich, and we can do these low risk and we can step back from all the high risk when we get a little older. But first, guys, we're starting at the bottom. So we have to pull out every tool we have. We need all the digging tools. We have to dig stairs so we can climb our way out of this hole. Some people will stand at the bottom of the hole and ask for people to throw ropes down. We won't do that. We're going to turn our fists into claws and we're going to dig stairs. We're going to dig stairs into the side of the hill and we're going to climb out. And those stairs, they're muddy and they're nasty, guys, and they're really freaking hard. But by the time we get to the top of the stairs, we can just stand up there with our low risks and make bunches of money, you know, like the rich boys. Finally, learn the basics of investing. Learn how to read stock charts and begin by picking some of your favorite companies and analyzing their financial statements. Keep in touch with recent news about industries you're interested in investing in. It's a good idea to have a basic understanding of what you're getting into so you're not investing blindly. And we will not invest blindly, guys. We're never going to just go in and randomly pick a stock because we like the ticker. Never going to happen. Not us. We are old top G's at this, even though we're just starting. So strategy number 1 is value investing, guys. These are bargain shoppers. They seek stocks they believe are undervalued. So this is a good idea. You know who does this value shopping, bargain shopping? This is our guy, Warren Buffett, guys. Warren Buffett loves to find an undervalued stock. He invests in them, which means he buys them the heck up, guys. And he lets the company take itself away with the money. So they look for stocks with prices they believe don't fully reflect the intrinsic value of the security. So he looks into their records, guys, the company's records. That's why we have to learn to read statements and things like that. So we can look into the company and we can see what their value is. And perhaps in the long term, we can get some good companies that we can turn into long-term investments, guys. So once we get our little nut grow, once it grows up, we can throw bargain investing in. So this value investing is predicated in part on the idea that some degree of irrationality exists in the market. This irrationality, in theory, presents opportunities to get a stock at a discounted price and make money from it. So if we go through Warren Buffett's, we'll see lots of stocks that did that. I was just watching a thing on Warren Buffett. I can't remember. Guys, get where you like to watch more things about investing. On YouTube, there are so many interesting things on YouTube, and it just teaches you so many words, and just hearing it helps. It's great. Look up YouTube. I'm going to start a folder of great things I watch also. Look for it in the next couple days. I'll have a stock investors, what should we call it? Good stock videos. That's what I'll call it for you guys. Good stock market videos. And then you guys can bop into the good stock market videos folder and watch them. And then we can talk about them later, or maybe you just watch them and you gain knowledge, okay? So it's not necessary for value investors to comb through volumes of financial data to find deals. Thousands of value mutual funds give investors the chance to own a basket of stocks thought to be undervalued. So somebody's already done the work. They grabbed a bunch of mutual funds, put them together. A mutual fund is a bunch of of them together, remember? The Russell 1000 Value Index, for example, is a popular benchmark for value investors, and several mutual funds mimic this index. For those who don't have time to perform exhaustive research, the price-earnings ratio has become the primary tool for quickly identifying undervalued or cheap stocks. This is a single number that comes from dividing a stock's share price by its earnings per share. A lower PE ratio signifies you're paying less per dollar of current earnings. Value investors seek companies with low PE ratio. So, if we want to value stock to see if it's worth it, we can check out the PE ratio really quick, guys, and you can do that on earnings per share and a stock share price. You can find that on, where's earnings per share? Right here. So it's all here, guys. It's just easy to find. It's just a quick, if it's a ratio, it's just one over the other. You just divide them and see what it is. Simple. And we'll practice some of those, guys. We're going to practice so that you can see. I know math isn't everybody's strong point, and I say PE ratio and you just divide them, and that makes sense to me because I teach basic sixth grade math all day to my daughter, so I'm up on ratios and statistics right now. My daughter is learning all of the percents and decimals and ratios right now. And boy, is it helpful in this, guys. Sixth grade math. It's so helpful. Everybody should go back and do sixth grade math sometime. So, who should use value investing? Value investing is best for investors looking to hold their securities long term. And that's not us, guys. Not yet. We're not long term yet, but this is where we're headed, so we have to know it. If you're investing in value companies, it may take years or longer for their businesses to scale. Value investing focuses on the big picture and often attempts to approach investing with a gradual growth mindset. And this is a great idea for people with money. If you have a lot of money, I would do this. I would value invest, just like Warren Buffett. People often cite legendary investor Warren Buffett as the epitome of a value investor. Consider Buffett's words when he made a substantial investment in the airline industry. He explained that airlines had a bad first century. Then he said, they got that century out of the way, I hope. This thinking exemplifies much of the value investing approach. Choices are based on decades of trends and with decades of future performance in mind. Over the long run, value investing has produced superior returns. However, value investing has seen prolonged periods where it's underperformed growth investing. One study from Dodge and Cox determined that value strategies have lagged behind growth strategies for a 10-year period during 3 periods over the last 90 years. So, out of 90 years, 10-year periods, there was 9 of those, 3 of them. That's not really bad, guys. 3 out of 9 it's a third. Those periods were the Great Depression, the technology stock bubble, and the period of 2004 to 2015. Indeed, value investing has consistently underperformed growth investing since 2007, producing a drawdown of more than 50% through 2020. It remains to be seen whether value stocks will regain their luster in the near future. So, the pros of value investing. There's long-term opportunity for large gains. Value companies also have stronger risk-reward relationships. The investing is rooted in fundamental analysis, so it's supported by financial matrix. And they're more likely to issue dividends. And guys, dividends, remember, are money that we can live off of or get more stock in the company. Value companies are often hard to find. They take time, and you have to be patient. And there's no guarantee of success. They could come out worse than they were before. So we also have to worry about our portfolio's diversification if you're only investing in sectors that are underperforming. So the next one is the one we are going to look at is growth strategy. Rather than look for low-cost deals, growth investors want investments that offer strong upside potential when it comes to future earnings of stock. It could be said that a growth investor is often looking for the next big thing. Growth investing, however, is not a reckless embrace of speculative investing. Rather, it involves evaluating a stock's current health as well as its potential growth. A drawback to growth investing is lack of dividends. If a company is in growth mode, it often needs capital to sustain its expansion. This doesn't leave much or any cash left over for dividend payments. Moreover, with faster earnings, growth comes higher valuations, which are, for most investors, a higher risk proposition. While there is no definitive list of hard metrics to guide a growth strategy, there are a few factors an investor should consider. Growth stocks do tend to outperform during periods of falling interest rates, as newer companies can find it less expensive to borrow in order to fuel innovation and expansion. It's important to keep in mind, however, that at first sign of a downturn in the economy, growth stocks are often the first to get hit. Growth investors also need to carefully consider the management prowess of a business's executive team. Achieving growth is among the most difficult challenges for a firm. Therefore, a stellar leadership team is required. At the same time, investors should evaluate the competition. A company may enjoy stellar growth, but if its primary product is easily replicated, the long-term prospects are dim. So, growth investing is inherently riskier and generally only thrives during certain economic conditions. And this is another thing, guys. We have to look at our economic condition right now is kind of changing. So we have to be cognizant of that as we are learning. Investors looking for shorter investing horizons with greater potential than value companies are best suited for growth investing. Growth investing is also ideal for investors that are not concerned with investment cash flow or dividends. According to a study from New York University's Stern School of Business, while growth investing underperforms value investing, especially over long time periods, it is also true that there are sub-periods where growth vesting dominates. The challenge, of course, is determining when these sub-periods will occur. While it's inadvisable to try and time the market, growth investing is most suitable for investors who believe strong market conditions lay ahead. Because growth companies are generally smaller and younger with less market presence, they are more likely to go bankrupt than value companies. It could be argued that growth investing is better for investors with greater disposable income, as there is greater downside for loss of capital compared to other investing strategies. So the pros are they aim for shorter term capital. And once they begin to grow, they often have the sharpest and greatest price increase. It doesn't rely heavily on technical analysis, so they could be easier. And they can often be boosted by momentum. Once it grows, it continues to grow. And the cons are they're often more volatile. Good times are good, bad times are bad. So, depending on macroeconomic conditions, growth stocks may be long-term holds. Growth companies, and we're not looking for growth right now, guys. We're looking for the up and downs, We will look for growth in the future, though. Growth companies rely on capital for expansion, so don't expect dividends. Growth companies often trade at high multiples of earnings. Entry into growth stocks may be higher than entry into other types of stocks. So, strategy 3 is momentum investment. Momentum investors ride the wave. They believe winners keep winning and losers keep losing. They look to buy stocks experiencing an uptrend. Because they believe losers continue to drop, they may choose to short sell those securities. Momentum investors are heavily reliant on technical analysis. They use a strictly data-driven approach to trading and look for patterns in stock prices to guide their purchasing decisions. We are definitely going to look up this one, guys. Tomorrow, what is technical analysis and the other one. Wait for this little thing to go away. Okay, so this adds additional weight to how a security has been traded in the short term. Momentum investors act in defiance of the efficient market hypothesis. This hypothesis states that asset prices fully reflect all information available to the public. A momentum investor believes that given all the publicly disclosed information, there are still material short-term price movements to happen as the markets aren't fully recognizing recent changes to the company. Despite some of its shortcomings, momentum investing has its appeal. Consider, for example, that the MSCI World Momentum Index, which has averaged annual gains of 10.75% since its inception through June 2022, compared to 7.59 for its benchmark over the same period. So it climbed this much, but they said it was going to climb this much. So it can still do more. So traders who adhere to a momentum strategy need to be at the switch and ready to buy and sell at all times. Profits build over months, not years. This is in contrast to simple buy and hold strategies that sell it and forget it approach. In addition to being heavily active with trading, momentum investing often calls for continual technical analysis. Momentum investing relies on data for proper entry and exit points. And these points are continually changing based on market sentiment. Market sentiment. For those with little interest in watching the market every day, there are momentum-style exchange-traded funds. And we will check out these ETFs, but guys, we are going to be momentum investing and staying on the market. That's the goal. We're going to sit at the market for a couple hours every day and learn it. So we are going to learn the momentum. I want to learn every way of trading, but most likely we're going to ride the highs and ride the lows, guys, so that we can make a bigger risk at first, a bigger gain. So, due to its highly speculative nature, momentum investing is among the riskiest strategies. And of course, that's the one I would pick, right? Because riskier means higher risk, means higher gain. It's more suitable for investors that have capital they're okay with potentially losing. And that's what I said. I'm okay. If we go in and we lose this $1,000, we'll get another $1,000 and we'll try again, guys. As this style of investing most closely resembles day trading, because you guys want to know why I feel like that about $1,000. People be like, but Squealer, you just throw away $1,000 to learn something? Of course I will. Of course. I will throw away $1,000 on anything because I've already done it. One time I threw away $1,000 on an Intex pool for my backyard. Paid $1,000. Bought the pool. And you don't want to know what happened to that pool, guys? I gave it to my brother, and it was green. It was so dirty. It was so disgusting. I wasted $1,000. I think my kids played in that pool like 5 times because, we're in the Pacific Northwest where it's cold. You don't need a pool in the Pacific Northwest, but I bought one. Wasted $1,000. I had to do so much work, too. We had to flatten the ground, dig, and do all kinds of stuff with that pool. I think it was like a whole job to put that pool in the backyard, and I don't have that pool anymore. It was $1,000 down the drain. We used it for a couple months, and it turned the greenest green I've ever seen, and the green did not make up for the money I lost. So, guys, it's okay to lose $1,000. Let me know in the comments how many times you've lost $1,000. I'm sure we all have $1,000 stories. It's okay. I'll make another $1,000 and I'll throw another $1,000 in there, and I'll keep doing it until I'm smart enough to turn that $1,000 into $100,000. Believe it. You guys are going to watch it. You guys one day are going to see me share my bank account, and it's going to say, guys, look, we went from $1,000 to $100,000. That's the goal, guys. We're going to do it. And then once we get that $100,000, guess what I'm going to do? I'm going to throw it in long-term investments and risk it again. You got to risk it for the biscuit, my friends. So, it's more suitable for investors that have capital they're okay with losing, as this style of investing most closely resembles day trading and has the greatest downside potential. So, pros. Higher risk means higher reward. Momentum trading is done on the short term, so we don't tie up our capital for a long time. We only got $1,000, guys. We got to make trades. Trades in, trades out, make our money. It can be seen as simpler. Doesn't rely on bigger picture. It's often the most exciting type of trading. Ooh, we're going to have some good times, guys. The cons, it requires a high degree of skill. This is why we're learning, guys. It does. It requires a high degree of skill. We are going to get that skill. Promise you. We are going to get the skill. Stay around and you will gain the skill. I'm getting the skill. If you want it, just hang out. Momentum trading relies on market volatility. Without prices rising or dropping, there may not be trades. So, there's risk for short-term capital gains. And invalidation can happen very quickly. An entry and exit point may no longer exist, and the opportunity is lost. Hey, that's life, guys, right? Sometimes you don't get in or get out quick enough, and your opportunity is lost. So the last one is strategy for dollar cost averaging. And it's called DCA. DCA is the practice of making regular investments in the market over time and is not mutually exclusive to the other methods described above. Rather, it is a means of executing whatever strategy you choose. With DCA, you may choose to put $300 in an investment account every month. This disciplined approach becomes particularly powerful when you use automated features that invest for you. The benefit of the DCA strategy is that it avoids the painful and ill-fated strategy of market timing. Even seasoned investors occasionally feel the temptation to buy when they think prices are low, only to discover, to their dismay, they have a longer way to drop. When investments happen in regular increments, the investor captures prices at all levels from high to low. These periodic investments effectively lower the average per share cost of the purchases and reduces the potential taxable basis for future shares. So what you do is like you buy ETF, which is an index, remember? So you have somebody do it like maybe a robo investor, and every month you put $300 in. So the first month you might buy at, let's just say that the stock is $100. So you buy 3 of the $100 stocks. Now you owe 3 stocks for $100. The next month you put in the $300, and now the stocks are $120. So you don't get 3 whole stocks, you only get 2.5 stocks. Now you own 5.5 stocks. So you paid a little bit more for the first 2, but now all of a sudden you have 5 stocks that you paid a total of $300 for. So you average that out, and it's about $60. You paid about $60 a stock rather than $100 a stock. You got a little bit of a discount or whatever. So you see how it kind of, that math might have been bad, guys. I'm not good at math off the top of my head. I need to like write it down. But anyway, you get what I'm saying. It spreads the cost over. So maybe if you, one time when you buy, they cost a little bit more than they did last time, it's okay. Maybe the prices are going up and you can sell soon. So, who should use this? Dollar cost averaging is a wise choice for most investors. It keeps you committed to saving while reducing the level of risk and the effects of volatility. Most investors are not in a position to make a single large investment. A DCA approach is an effective countermeasure to the cognitive bias inherent in humans. New and experienced investors alike are susceptible to hardwired flaws in judgment. Loss of aversion bias, for example, causes us to view the gain or loss of an amount of money asymmetrically. Additionally, confirmation bias leads us to focus on and remember information that confirms our long-held beliefs while ignoring contradictory information that may be important. Dollar cost averaging circumvents these common problems by removing human frailties from the equation. Damn. So, loss aversion, guys, and confirmation bias, they will make us do bad things. So if you do the dollar cost averaging and you just stick $300 in an ETF and let them do the work for you, you remove all of that. And I am not saying that that's a bad idea. If you guys want to go about it that way, hey, that's a good idea. It's good risk management. In order to establish an effective DCA strategy, you must have ongoing cash flow and reoccurring disposable income. So let's say you guys got a good job right now. It looks like a good option, right? A lot of us are not in that where we can put $300 all the time. So perhaps we just have to save up and learn while we do it, and that's okay. Many online brokers have options set up reoccurring deposits during a specific cadence. This feature can then be adjusted based on changes in your personal cash flow or investment preference. So the pros are it can combine with other strategies. So we could do both, guys. Let's say down the road we're making so much money that instead of making our nut bigger, we throw $300 a month into ETFs to gain this way, slow, robo type. So during periods of declining prices, your average cost basis will decrease, increasing potential future gains. It removes the emotional element of investing. So maybe after all of this learning, you can't get over your emotionalness, and that's okay because you can do this way, right? Once set up, DCA can be incredibly passive and require minimal maintenance. So maybe you're busy. You already have another job, and this is the only way you can trade. That's okay. They did it for you. DCA can be difficult to automate, especially if you're not familiar with your broker's platform. That's why you're here, guys. We get very familiar, and I can help you set one of these up. We just have to get there. During periods of declining prices, your average cost basis will decrease, increasing your future tax liability. You must have steady, stable cash flow, and that takes a lot of us right out of it. Maybe you don't have a steady, stable cash flow that you can invest. Maybe you can only invest sometimes. And you may be tempted to not monitor your strategies. And it should always be reviewed, guys. So, now you've narrowed down a strategy. Great. We know we'll probably, out of these strategies, guys, we're going to be obviously doing the momentum trading at first so we can kind of get our momentum going and get some money making. So the best way to invest, we're going to use one of ours brokers, probably TD Ameritrade. Webull said we cannot trade options. Webull. It's like a weevil. If you choose the latter, consider signing up with a robo-advisor. So consider your investment vehicles. Cash accounts can be immediately withdrawn, but often have the greatest consequences. 401ks can't be touched until you retire. So you have different types of IRAs have different levels of flexibility. It also pays to remain diversified to reduce the risk of one type of asset bringing down your entire portfolio. Consider spreading your investments across stocks, bonds, mutual funds, ETFs, and alternative assets. And eventually, guys, that is definitely our goal. We want to have a portfolio with stocks, bonds, mutual funds, ETFs, alternative assets like crypto. If you're someone who is socially conscious, you may consider responsible investing. Now is the time to figure out what you want your investing portfolio to be made of and what it will look like. What's responsible investing? Social responsibility due to the nature of business the company conducts. Oh, no, I'm not going to be socially responsible, guys. If a business steals from people and they're a good investment, I'm going to invest in them. Know why? Because I have no emotions. Responsible investing puts emotions in your investing, and I can't allow that. I can't allow that for myself. If you want to put emotions into your investing, go ahead, guys. But if the company is a company and other people can invest in it, Squealer D is going to invest in it if it's a good investment. So, every time you choose your investment strategy, you want to answer each of these questions. And remember, guys, we can change our investment strategies. We might go different once we have a lot of money, right? Once we get rich, we might change our ideas. So we need to know all the strategies. So do you want to invest for short or long? Do you want your investments to be easy accessible or illiquid? Meaning they're stuck, guys. Like your 401k, stuck. Do you want to chase risk for higher returns or avoid risk for stability? Do you want to manage your own investments or pay an advisor? Do you want to actively monitor your portfolio or do you want to be passive? Do you want to invest a little over time or a lot all at once? So the best strategy is one that helps you achieve your financial goals, guys. For every investor, the strategy will be different. For example, if you're looking for the quickest profit with the highest risk, momentum trading is for you. Alternatively, if you're planning for the long term, value stocks are probably better. And we don't have to do this and only do one, guys. We get in on the momentum and we get rich, and then we bam into the long term value stocks and we Warren Buffett it out. So a general investment strategy is formed based on your long-term goals. How much are you trying to save? What is your timeline for saving? What are you trying to achieve? Once you have your financial goals in place, you can set target performance on returns and savings, then find assets that mesh with the plan. For example, your goal may be to save $100,000, or that's $1 million. Well, let's save $1 million. I said $100,000. Let's turn this $1,000 into $1 million. That's better. To achieve this goal, you must invest $10,000 per year for 29 years and achieve 8% annual returns. Okay. 29 years, guys. 30 more years. That means I'll be 70. If I can do a $10,000 a year, man, armed with this information, you can analyze various historical investment performance to try and find an asset class that achieves your strat. Okay, so if we need this, guys, $10,000 a year off of $1,000, it might take us more than 29 years, guys. It might take me my whole 40 years to get this $1 million, but we're going to do it. This is going to be a long one, guys. I've got another 40 years on this game. And that's okay. Look, I already put 40 years into the crap game of just living my life. I had 2 back surgeries. It was a really crappy game. I'm looking for a better game now, guys. How do beginners invest in stock? Beginners can get started with stocks by depositing funds in a low fee or no fee brokerage firm. These brokerage companies will not charge or issue small charges when the investor deposits, trades, or withdraws funds. In addition to getting started with a brokerage firm, you can leverage information on the broker's website to begin researching which asset classes and securities you're interested in. The bottom line, the decision to choose a strategy is more important than the strategy itself. Indeed, any of these strategies can generate a significant return as long as the investor makes a choice and commits to it. The reason it's important to choose is the sooner you start, the greater the effects of compounding. Guys, that's what we kind of talk about, exponential compounding. You start with $100, 7%, you end up with $107, you end up with $114.49, you end up with $122. Compound your money. Remember, don't focus exclusively on annual returns when choosing a strategy. Engage the approach that suits your schedule and risk tolerance. With a plan in place and goal set, you will be well on your way to a long and successful investing future. So, we are done with that article for the day. That was beautiful. I have one more thing to show you guys before we go for the day. Let me pull it up. Where is it? I gotta find it. I made something, guys. That's not it. Hold on. Where is it? I made something. And I will share it with you guys. Because I'm nice like that. Where is it? Can I share it? Will it let me share it? Hold on. I got to figure out how to show it on the screen, guys. I got to figure out how to show it. That's not what I wanted to show you, huh? Well. It didn't show you. Now it doesn't show you anything, huh? Well, I sure messed that up. What's happening? Okay, well, I can't show you. I don't know why. It won't let me show you. I'm trying to show my screen to show this so I can show them what I made for my journal. But I can't get it to show.
Yeah, it's only going to show your
here.
You gotta add a different source.
Oh. Okay, so guys, I will show you next time. I'm making us, it's not finished anyway, so I was just prematurely showing you. But what I'm doing is making us a journal entries, guys, so that when we write down our trades, we can put them in a journal and have them so we can study off of them, guys. So I'm making it up on an Excel sheet, and all we have to do is just, I'll put it up in the description when we're ready, when it's finished, and you guys can just download it. And you could keep it on your computer and do it, or you can print it out and have an actual little hard book. So that's what that is, and that's what I'm doing. Look forward to seeing that next time. Next week, we will be back, guys. Monday morning, more learning. I'm going to let you have the weekend off with no homework. Just get ready to open up a TD Ameritrade this weekend if you guys can, so that we can jump into Thinkorswim. And I have mine right here, guys. Here's my paper trade. Thinkorswim is right here. Open up yourself an account. Here's my account information right over here on this side. Open up a TD Ameritrade. Like I said, Webull won't let me do, Webull will not let me do options. I don't know why, but they said I don't qualify. So go ahead and bop onto TD Ameritrade and open up an account. Monday morning, we are going to check some stocks, and maybe we'll make a trade. I'm going to have my new journal out for you guys, so it's all going to be new stuff. See you Monday morning. Same time, same place. Be there or be square, neighbors. Have a great day, and I will see you tonight if you're interested in the magical world of Hogwarts, witchcraft, and wizardry.